If you own your home in the UK and you're over 60, stop scrolling for a minute. Because July 2026 has just brought 3 changes to property and tax rules that could quietly affect your savings, your benefits, and what your family inherits when you're gone. One came straight out of Downing Street just over a week ago. Another is a hidden trap already stripping benefits away from pensioners who have no idea what caused it. And the third involves a home selling rule most people think they understand, but don't. Welcome back to Pension and Benefits Guide, the channel that breaks down property and tax rules in plain English, without the jargon. If you're new here, hit subscribe, because we cover exactly this kind of thing every week. Let's start with Downing Street. Andy Burnham became Prime Minister on the 20th of July, 2026, after Keir Starmer resigned. In his first interview, Burnham confirmed the mansion tax, officially the high-value council tax surcharge, is staying. It's an annual charge on English homes worth over £2 million, ranging from £2,500 to £7,500 a year, starting April 2028. But here's the part that matters more. On the day Burnham took office, the Homeowners Alliance reported active speculation that this threshold could drop from £2 million to £1.5 million. Not confirmed, not law, but being discussed at the highest level. Why should ordinary pensioners care? Because house prices have climbed so much that the ONS confirms over 150,000 English properties are now worth above £1.5 million. A lot of people who bought ordinary family homes decades ago could suddenly face a charge they never planned for. And here's something that's already law. The Finance Act 2026 confirms that from April 2027, unspent pension pots will count as part of your estate for inheritance tax for the first time, attracting the standard 40% charge above the nil rate band. If your property and pension together push your estate over that threshold, get advice now, because that window is closing. Now the second issue, the one the financial services industry hopes you never hear about, because it's quietly wiping out benefits for pensioners who thought equity release was a smart move. You take a lump sum from your home's value, stay living there, and repay it later from the sale. What brokers rarely explain clearly is what that lump sum does to your benefits the moment it lands. Under DWP rules, that cash counts as capital immediately. Above £10,000, pension credit starts shrinking, £1 a week for every £250 over the limit. Above £16,000, pension credit is cancelled completely. Here's where it really hits home. Take £20,000 via equity release, and your pension credit can vanish overnight. With it goes council tax reduction worth up to £2,500 a year, the warm home discount, cold weather payments, free NHS dental care, and your free TV licence at 75. That can total £3,000 to £4,000 lost every single year. Quick pause, if this is useful, tap like and drop a comment with where you're watching from, it really helps this channel reach more people who need it. The fix most brokers won't volunteer is the drawdown option. Instead of one lump sum, draw the money in smaller chunks, say £4,000 at a time, keeping your balance under £10,000 between draws. Same money eventually, same broker commission, but your pension credit stays intact, saving you potentially tens of thousands over 5 years. So the one question to ask your broker, can drawdown protect my pension credit instead of triggering its loss? Finally, the third issue, selling your main home. Private residence relief exempts your home's profit from capital gains tax while you live there. But after you move out, you only get a 9-month grace period before HMRC starts taxing part of the gain. Picture this, someone moves into care in January 2025, and the family takes 15 months to sell. 9 months are covered by the grace period, but the last 6 months aren't. HMRC taxes the gain on those 6 months at 18 or 24%, depending on your tax band, and on a property that's grown for decades, that bill can be substantial. So if you or someone you know is moving into care, moving in with family, or just taking time to sell, that 9-month clock starts the day they move out, not the day you decide to sell. Get tax advice before those 9 months run out, while your options are still open. So, bringing it all together, Burnham's arrival confirms the mansion tax from 2028 and raises the risk of a lower 1.5 million threshold. Pension pots join your inheritance tax estate from April 2027, so review your estate now. Equity release lump sums can wipe out pension credit above £16,000, consider drawdown instead. And if you've already moved out of your main home, that 9-month CGT clock is ticking. Which of these 3 surprised you the most, the mansion tax, the equity release trap, or the 9-month rule? Tell me in the comments. If this helped, share it with someone over 60 who owns their home, hit subscribe, and I'll see you in the next one.